Sam Chandan, you're the Global Chief Economist and Executive Vice President of Real Capital Analytics based in New York and London. Where do you see the transaction activity taking place?
I think earlier this year we had seen transaction activity really picking up in China, Asia Pacific, and in the United Kingdom and in Europe as well. There are a couple of things that have happened in the macroeconomic environment since then that have resulted in a slowdown in both of these areas. I think in the United Kingdom and in parts of Europe, the sovereign debt crises in Spain, Italy, Portugal, Greece, Ireland, Iceland have worked to slow the economies in Europe, but as a result of that have also made investors a little more hesitant in making commercial real estate acquisitions. So we've seen activity start to slow down a little bit in Europe, both on the continent and in the UK. As far as China, that had really been the market that was leading the resumption in global activity last year. The government in China has grown concerned about how quickly prices have been increasing, how quickly transaction activity, volumes have been picking up, in particular for development sites. And so the government has worked to constrain activity, the availability of credit, the ease with which you might transfer title to land. And so in the second and third quarters of this year, we've actually seen Asia Pacific volumes slow down. That leaves the United States. Activity has picked up in the US through the second and third quarters, but it does remain very low as compared to where we were a couple of years ago. So overall, our preliminary assessment for the third quarter is that global volume has actually slowed a little bit.
And which countries in Europe do you think may be in trouble?
I think from an economic perspective, certainly Greece faces very clear challenges. What has moderated the impact or the potential for spillover from the situation in Greece into other European economies is that Greece is actually a relatively small part of the Eurozone in terms of overall economic activity. The challenge we face, of course, is that while Germany is on very sound footing, is a strong export economy, particularly in the auto sector and for specialty machinery, it's also the case that there are very real challenges in Ireland, in Spain, and in Italy that may constrain their ability to finance public sector activity and further stimulus. And unfortunately, at this juncture, it doesn't look as though the private sector is in a position to independently really drive significant growth trends in those economies. In the UK, a bit of a different situation. There are real austerity measures in place already that will, in the short term, act to constrain growth. But I think they've also created a sense of confidence amongst businesses that the government is willing to tackle the deficit in a meaningful way. And that has allowed many businesses that previously had really held off to move forward on plans that they might not otherwise have moved forward on if they were concerned about whether there would be a chronic deficit challenge in the UK.
We hear the word double dip mentioned quite often.
Yes.
What do you think, is this going to happen, or is it just
in the
scaremongering?
United States, certainly, where I think there is a lot of discussion around the double dip or the potential for a double dip, the underlying economic indicators are still stable enough that those downside risks are manageable within the context of very active policy making, very easy monetary policy, very low interest rates. The challenges, I think, are more significant in parts of Europe. And if we were to see a global double dip, it would be because of a significant downturn in Europe that would ultimately spill over into other areas, where there is an outside risk, and one that I think is significantly underpriced by the market, is the potential for a rather abrupt adjustment in property prices in China. So we've seen in very clear ways in Europe and the United States over the last couple of years how declines in house prices, for example, the deflation of the housing market can wreak havoc on the economy as a whole. They're managing with similar issues, although not to the same degree, with property markets in China. If that attempt to slow the property markets is not managed in a way that allows for a soft landing, so to speak, then there is the potential there as well. So we have to realize that although what we would refer to as the advanced economies have been growing very slowly, have been struggling to return to growth, over the course of last year. In 2009, 2010, the dominant contributor to global economic growth has been China. And so it's to the advantage of the global market as a whole that we continue to see growth and prosperity there.